Welcome back to Market on Close. Big day for U.S. stocks, broad leadership. We're going to get more into the weeds of what worked today. Let's talk some bigger picture here as we head into the close. Shana Sissel is joining me right now, Chief Investment Officer at the Spotlight Asset Group. Shana, great to have you back on the show. I know that we both share eagerness to get outside, but the market apparently has eagerness to buy up Tesla, Virgin Galactic today, AMD. I mean, is this really where we're at? Are the good times about to kick off again?
No, I don't think so. I think that we are definitely going to have some struggles and continued volatility in the market going forward as we start to get more clarity on how we're going to reopen the economy and how the governors are going to work together to sort of make it an organized reopening. I just can't imagine. The market is only down 15% from its all-time high. We're about to enter into a recession that could be on par with what we had in the 1930s. Now, I'm not saying that the market shouldn't be include that into their pricing, but I just think that today is not a reflection of what the market should be or will be doing, you know, a week from now, a month from now.
What's the easiest explanation? I mean, do we just, again, kind of, I know that I kind of jokingly tweeted out a couple weeks ago that when this market starts rallying on positive virus news, people are going to break out the balance sheet charts, but I don't know. I mean, when you see some of the frothy names start to rally, whatever happened to the story I was hearing that it was going to be like cyclical and high quality and companies with good balance sheets? I mean, are we just going to buy up everything again?
Well, I don't think we should. That doesn't mean we won't. We have a lot of stimulus in the system right now, so some of that money is clearly going to work. I think people feel like the market has priced in a lot of downside. People expect really bad news. So even when bad news comes out, people are anticipating that. So the market is ahead of that. I think that the discussion from the governors about plans to reopen and the fact that they've sort of shifted their perspective into thinking that way and not just on how we're going to continue to keep the virus under control and keep people sheltered in place is a positive for the markets. I think that negative guidance has come out. A lot of firms have lowered the initial guidance they put out, and that maybe isn't as bad as investors are expecting. But I really don't think the market is fairly valued right now based on what we're going to experience over the next 6 to 12 months. And I do expect that we will retest the bottoms. Have we already seen the bottom? I don't know. You never really know that till you're well past it. But I think that it is likely that we will continue to test the lows.
So if we have an environment that's going to be choppy waters going forward, that's not just straight up, what do you like right now? I'll start with the fund that you've talked about with us for quite some time on the show, the anti-beta fund. I mean, the thing is right near the highs. It's done great throughout the sell-off. You and I have discussed whether or not this thing is going to trade next to like a safety asset like bonds. I mean, it kind of looks like that on the chart, but I mean, it's hard to argue the trend here. Does it continue?
Well, I think BTEL has a lot of things going for it. As you know, it's one of my favorite ETFs that are out there. It's very unique. As long as lower volatility stocks outperform higher volatility stocks, because that's how it's positioned. It's long, low vol, and short, high vol. As long as that continues to happen, even if both are negative, the fund will be positive. And I think in a really volatile market that this is the type of fund that will continue to do well. As I'm sure you're aware, it's up almost 14% year to date. And for a fund that has equity exposure, I think that that's a really attractive opportunity for investors. Will it continue to do that? I don't know. But again, if those things come into play, if low volatility stocks continue to outperform high volatility stocks, which typically happens when we have a lot of volatility in the market, that'll be positive for this fund.
Right now, it's unchanged on the day where stocks are obviously rising. So it's going to take something big in terms of trend shift to move this. I again point to rates. It looks like if you do get some different shape of relationships after this, right? Before this, it was by stocks, by bonds, and the bond part kind of having that tie-in, if there's utilities that are in here, if there's the kind of more recent momentum. I mean, what's it going to be tied to? Do we know what its interest rate and duration kind of exposure is? Because I don't even know if this thing is long some of the bond proxies and utilities anymore, because they've become like the momentum and high swinging trade. I mean, I think some of those companies are in the beta category now.
It might very well be. I think, as I said, generally speaking, low vol has always traded a premium, and in a volatile market, low vol works. It does have some duration risk in it, as a lot of dividend-paying stocks tend to be lower vol. But I think that that's more correlation, less causation. I don't know necessarily that it's particularly sensitive to duration. The fund doesn't have a very, very long track record so that you can see that kind of volatility. Obviously, we've been in a market where rates have been going down for the most part. So, you know, it's done well in that environment. There's no reason to believe that it wouldn't continue to do so. But again, this is more of a hedge on equity. It does do better when the volatility is high in the market. And so it can provide some dampering and hedge in your portfolio as we kind of go through the next few months.
I see. Okay. So sort of an additional way to have some indirect, you've got equity exposure in there, but again, if the market stays choppy, you're not going to be tied to the direction of the S&P 500. What about for sort of like a core, if somebody says, hey, I want to have just good companies in general, what do you use? Are there funds that right now you think adequately capture stocks that'll be able to weather, debt pressure, weather some of the economic slowdown that are coming?
Sure. So there's one QARP, which is the X-Trackers Russell 1000 quality at a reasonable price ETF. That is an ETF that focuses on companies with low leverage, strong balance sheets, market leaders in their space. This is Russell 1000. It's large cap. That should have some protection to it. But also keep in mind, these types of markets tend to be very favorable, believe it or not, to deeper value type of investing. And if you look at 2008, 2009, and you look back at other times where we've seen market downturns, coming out of that, some of those deeper value names tend to do well. So something like FVAL, which is the Fidelity Value Factor ETF, is interesting here. And there are some active managers in this space, like the Tocqueville Phoenix Fund, the ticker TOPHX, that has typically done well in these types of environments. So there's quite a few different ways to play it. It really is dependent on what your risk tolerance is. I'm hesitant to recommend any sort of bond-oriented, fixed income-oriented managers. I think there's a lot of risk in fixed income right now. And so I'm looking at more creative ways to take advantage of the environment where I can have some hedge. And that's why I like BTAL. That's why I like CHEP, CHEP. And then when I think about how these market cycles work and what works coming off of a bottom, that's where opportunities in something like the Tocqueville Phoenix Fund, Hotchkiss & Wiley's fundamental large cap value, those are all strategies that typically do well coming off a bottom. But again, we don't know if we've seen our bottom or not. I'm just kind of thinking, depending on your risk tolerance, how you would potentially want to position your portfolio for the next 12 months.
Real quick, before we let you go, Shana, to that point, sounds like, number one, I'll just point out, correct me if I'm wrong, but it sounds like kind of having that value tilt as a style as your preference for the core equity exposure. But the other point here, you mentioned you don't want to have a ton piled up into fixed income bonds right now, but I see in your notes you also like real estate. Is that just that the economic comeback could outweigh whatever interest rate headwind they might have?
Well, some interesting facts here. My husband and I have been looking at some real estate in the last few months, and our realtor has pointed out that they've actually seen an uptick in interest because suburban city dwellers who have kids who are stuck in small apartments with no outdoor space are dying to get somewhere in the suburbs with backyards. So they've actually seen an uptick in interest in single-family homes. But above and beyond that, interest rates are at basically zero. The cost of a mortgage right now for anyone with good credit is very low. And so now would be an opportunity. It's also a great time if you're an investor in real estate to look at that, because the potential payoff in cash flows would be very positive at this point. So that's why I like real estate.
All right, so everybody now wants They know what they don't have, and now we want more. I'm kind of digging the yard conversation right now too. I got to be honest. Appreciate it, Shana. Great to catch up as always. Shana Sissel joining us here as we wrap up the market. Chief Investment Officer at Spotlight Asset Group. She's nailed the move in BTAL. We'll see if it can continue the strength here and looking at potential value performance.